Hey everybody, how are you doing? Good afternoon on a chilly afternoon here in Brooklyn in March to you all. I decided to wear my leather jacket today because it seems the folks in the tech industry wear leather jackets all the time while I'm presenting, and the industry's done really well. So their valuations are huge in biotech. We're hoping for something similar. So I figured putting on the leather jacket, might have some luck rub off on us. So again, welcome back to the Biotech Capital Compass. Today we're going to be continuing our Gilead series with a video companion around part 2. This was a newsletter that we published just over a week ago, and we entitled it "How Investors Are Repricing the Gilead Story." In the Gilead series is essentially about 4 parts. The first part was a video recap of a call we had done on the HIV franchise quite a while ago, and then some follow-up work we had done on HIV for Gilead. And there we examined the HIV franchise and the transition towards long-acting prevention and treatment. But today I want to step back and look at something different. Not just the science, not just the pipeline, but how the market may be starting to reinterpret Gilead as a company. Because for most of the past decade, the narrative around Gilead was very simple. It was a company that experienced one of the greatest revenue booms in pharmaceutical history, followed by one of the most dramatic revenue declines. And the question investors have been asking ever since is, can Gilead become a compounder again? This is something that, if you know Gilead, has been haunting it since literally about the mid 2010s till maybe recently, maybe a year or 2 years ago, and might still be if the company hits a bad patch, which we don't expect it to, but one never knows. So let's talk about the ghost of the hepatitis C era. This was a company that Gilead acquired called Pharmasset. And to understand why this question, this ghost of the HCV era, still hangs over the stock, we have to go back about 10 years ago. In the mid-2010s, Gilead's hepatitis C franchise, led by Sovaldi and Harvoni, generated extraordinary revenues. And this is a purchase for a company that they had bought and then finalized developing of those drugs and then launched those drugs. At its peak, the HCV business produced more than 19 billion annually. And it was actually one of the fastest market launches ever, if not the fastest ever that occurred actually in biotech and pharma. But unlike most pharmaceutical markets, hepatitis C had an unusual dynamic. The drugs didn't just treat the disease, they cured it. So which meant the patient pool shrank rapidly once treatment expanded globally. So ironically, one of the greatest therapeutic successes in modern medicine created a massive financial headwind for the company. I, for one, have always lauded the company that went ahead knowing that this was going to happen and decided to launch this drug and go worldwide anyways with it. So once, vast majority of this patient pool was cured, revenue fell sharply and investors began asking a very uncomfortable question: what does Gilead look like after HCV? If you actually look at Gilead's valuation before the hepatitis C boom, and then after, the valuation even after the revenue drop off, was still greater than before the valuation, before they started selling the drug. So net, they made out, but that immense move up in valuation and then down caused, a lot of happiness on the way up and a lot of pain on the way down for quite a few investors. COVID-19 companies have gone through the same thing. COVID-19 vaccine companies, and their valuations are still actually higher than what they were before, COVID-19 hit in 2020. So, again, let's go back here and ask, what does Gilead look again after HCV? The second shock to this company was filgotinib. This is just as the company is trying to rebuild, another blow landed. Filgotinib, a JAK inhibitor that Gilead hoped would anchor a new immunology franchise, ran into regulatory concerns in the United States. The program ultimately failed to become the commercial pillar management had hoped for. So by the early 2020s, the investment narrative around Gilead had become fairly skeptical. Great HIV business, strong cash flow, but unclear long-term growth. I worked actually, on Wall Street as a sell-side analyst at that time, and I was covering Gilead. I used to have quite a few clients ask me at that point, why does another company not just buy out Gilead? In fact, AstraZeneca tried to merge with Gilead at one point, was not successful, but it was on the minds in the early 2020s of a lot of investment professionals, especially buy-siders. So, quiet repositioning has been going on at Gilead over the past few years. However, something interesting has been happening. Gilead has been slowly repositioning itself, not through a single transformational product, but through a sequence of strategic steps. And a lot of this credit can be given to the CEO. Of course, it started way before him, but the CEO, current CEO Daniel O'Day, who came, from Roche, probably accelerated that process. So first, the HIV franchise continued to perform extremely well, particularly with Biktarvy, becoming one of the most successful HIV therapies ever launched. Second, the company began investing heavily in oncology, including the acquisition of Immunomedics and the development of Trodelvy. Third, Gilead expanded into cell therapy through Kite Pharma. The Kite Pharma purchase was before Immunomedics, but this is sort of, the overall strategy that Gilead has been thinking of, getting into oncology. Kite Pharma was available earlier, then Immunomedics, and now we're seeing the emergence of long-acting HIV therapies built around lenacapavir. And those long-acting HIV therapies are very important because it takes the HIV intellectual property or patents, which run into about the mid 2030s to the late 2030s, and extends them into the 2040s. That's pretty amazing. Now, none of these will individually replace the hepatitis C franchise as it existed, 5, 10 years ago, but together they begin to build something different, a diversified large cap biotech platform. And what is the stock telling us? One of the reasons this conversation is resurfacing now is very simple. The stock has been behaving differently. Year to date in 2026, Gilead has materially outperformed biotech ETFs like the XBI and the IBB. Over the past 3 years, it has also outperformed much of the biotech sector, even while tracking broader market returns. That doesn't prove anything on its own, but it does suggest something important. Investors may be quietly repositioning around the company again, and that repositioning appears to be tied to two main developments. First, estimate revisions. So these are forward revenue and earnings estimates. Analysts who follow this company, have their forward revenue estimates revisions, each one of them individually. They send their models in to providers like Bloomberg, First Call, FactSet. Those roll them up and give you the average value, which is called consensus. So if you look at Bloomberg consensus forecasts, which we look at, something subtle but important has been happening. Forward revenue and earnings estimates for the late 2020s has been trending upwards. Not dramatically, but steadily. Analysts now model Gilead potentially moving from roughly $29 billion in annual revenue toward the mid to high $30 billion range by the end of the decade. And importantly, that growth isn't modeled as coming from a single product. Instead, it reflects contributions from several areas: HIV life cycle innovation, long-acting prevention from lenacapavir, oncology programs like Trodelvy, which is solid tumors, expansion in cell therapy, which is more geared towards liquid tumors or what's called blood cancer, liver disease treatments. In other words, the financial model for Gilead is slowly shifting from mature franchise, mostly HIV, to steady compounder. So the second part, of this change in at least the Wall Street perception that's also showing up in Gilead's share price is the pipeline cadence. The next 2 years could be particularly important. Several programs are approaching meaningful milestones. In HIV, bictegravir, lenacapavir, this is a two combo pill, could become an important bridge towards long-acting treatment. In oncology, the BCMA CAR T therapy anito-cel, developed with Arcellx, is approaching regulatory review in multiple myeloma. Gilead just purchased that company, Arcellx. Trodelvy continues to expand into early line breast cancer and other tumors. And in liver diseases, bulevirtide could provide a meaningful niche expansion. Individually, none of these transform the company overnight, but collectively they create a steady cadence of catalysts that can gradually broaden the revenue base. So, again, the strategic hinge here is from a product perspective, lenacapavir. This is an HIV drug. And if there's one main asset analysts keep coming back to, it's lenacapavir. We highlighted this in our Part 2 newsletter. Many investors are asking a variation of the same question. Can lenacapavir reshape the HIV market the way Biktarvy once did? Biktarvy is Gilead's drug that's almost annualizing about $20 billion per year, or will get there. It's on the way to getting there. And analysts are asking, and Biktarvy's patent life or IP goes around the mid-2030s to the late 2030s. And so, that's what analysts are asking now 10 years ahead of time, that, can lenacapavir reshape the HIV market? But this time in a long-acting form. The opportunity is large. long-acting prevention and treatment could fundamentally change adherence patterns and patient preferences. And if Gilead successfully builds a portfolio of regimens around lenacapavir, daily, weekly, and potentially long-term duration options, it could extend HIV leadership well into the next decade. So, let's talk about the valuation question here now, really. The market seems to be responding. Gilead's valuation multiple expanded relative to its own history. For years, the company traded around roughly 12x forward earnings. More recently, that multiple has moved closer to 16x, still reasonable for a profitable large cap biotech. But when biotech has really gotten going and has been in its boomtown phases, for example, in the 2005, 2008 time frame, 2013 to 2017, the forward multiple traded like as high as 25, 30 times, 1 year forward earnings. So right now, Gilead's at 16. And just remember, every year, earnings keep on going up. So this is still reasonable for a profitable large cap biotech, but clearly reflecting greater confidence in the durability of the business. In other words, part of the stock's performance may not just be earnings growth, it might be a structural re-rating, what we call multiple expansion. So investors are giving it a higher multiple as growth keeps on accelerating, through this more diversified, both commercial product strategy and pipeline portfolio. The risk here, of course, this is not a story, without risks. The Yeztugo launch remains to prove durable in real-world adoption. That's the commercial name of lenacapavir. Lenacapavir is the scientific name. Yeztugo is the commercial name. Always a little confusing to people who are new to biotech. Still confusing to me after 30 years. HIV pricing policy remains an ongoing question, and oncology, particularly cell therapy, still requires careful execution. Investors will be watching closely over the next few years. So, why does this matter for the Biotech Capital Compass? Why have we done this 4-part series with Gilead? One of the things that we're doing in this series and several upcoming newsletters is building a framework for how large cap biotech companies create long-term value. So that's also part of what the Biotech Capital Compass is all about. It's not just an investing newsletter. We choose a few stocks and, we really focus on them. And we think, investors should, if they like biotech, really get into them. But also we want to help in terms of education. We want to help investors build a framework for how large cap biotech companies, again, can create long-term value. Each company represents a slightly different model. Gilead is the reinvention model, a company that had to rebuild after one of the largest revenue cliffs in pharmaceutical history. In upcoming pieces, we'll look at other companies, other examples. Biogen, a company navigating a major neuroscience transition. Regeneron, perhaps the most consistent innovation engine in biotech. United Therapeutics, a fascinating model built around rare disease leadership and also functioning in an area where there's a lot of what's called branded generics and generics. How does United Therapeutics do that? And it does it very successfully and through a patient-centric focus. And Vertex, a company that has quietly become one of the most durable compounders in the industry. Each one illustrates a different path. So, in closing, for Gilead, the key question now is fairly simple. Has the company finally moved past the shadow of the HCV hepatitis C collapse? Hepatitis C collapse, I apologize. Or are we still in the early stages of that transition? The market may already be starting to answer. By the next several years of commercial execution and pipeline milestones will likely determine whether Gilead fully reestablishes itself as one of biotech's long-term compounders. These next few years are going to be really, really important, but this is a story that could really run for a while, in my belief. And I love, stories and shares and stocks like that. Those are the ones I like recommending to people. And, thank you again for joining me on the Biotech Capital Compass today. I'll see you in the next piece. Really appreciate all the support. If you like this, please give it a like, share it, and forward it to people. As always, thank you and have a good day. Take care.